What if I told you that most Americans are going broke because of this number one problem? What's going on, everyone? This is Chris Reyes, a young Chicago entrepreneur. So, if you don't know, now you know I'm the youngest Chicago branch manager. There's no one else with their own mortgage office at 23 years young. So, today we're going to be making a video talking about assets versus liabilities. I think it's very fitting since I'm in the real estate space. What better topic to start off with than a simple video like assets versus liabilities? I think a lot of people in the real estate space got into it because of a popular book, Rich Dad, Poor Dad, which specifically covers these topics. So I'm going to simplify them and hopefully you guys find this video entertaining. So let's keep this simple. What is an asset and what is a liability? So an asset is anything that puts money in your pocket. A liability is anything that takes money out of your pocket. Short and simple. So it's not what your accountant says. It's what's making you richer or poorer. If it's not putting money in your pocket, it's a liability. Just putting money in your pocket, it's an asset. For example, they might say a car is a liability, but if you're renting it out, then that's an asset. If you have a property that's actually burning through cash and it's causing problems, that's a liability. Quick question for y'all, man. Think about your life. What are some liabilities in your life? What are some things that are draining money slowly? Is it the car? Is it, a boat? What is it? But liabilities are things that are silently making you poor. Here's the truth. A lot of people buy liabilities without realizing that they're bad liabilities. Like if you finance a large home and it's not making you any money, that's a liability. I see that a lot in the mortgage business, especially when you're buying properties anywhere between 300 to 400,000. You're paying $3,000 a month for principal, interest, tax, and insurance. And so a lot of families, half their income is going towards the mortgage before they even see the property, especially since you're approved based off of your gross income rather than your net income. This is a huge way that I see a lot of people, they kill their wealth without even really realizing it. Here's a quick story. So when I first got into business and I started doing good, I had a friend ask me, what was the first big purchase I was going to make? And even though first in the business, we were able to make six figures, I waited until like my third year, which is now, to buy a new Mercedes. And the reason was I felt like even though I was making good money, I didn't want to be a victim to lifestyle inflation. Even if you do buy liabilities, you got to do it smart in a way where it's only a portion of your income. So right now, the payment is probably like 10% of my gross income. So it's really not much. So it all starts with building the right mindset. I feel like, especially now that I started my own office and I became a branch manager, I started auditing a lot of my personal expenses. When I first got my profit and loss statement for the office, there was a lot of unexpected fees. So because of that, I started looking at my own personal statements and like, what am I spending money on that I could be saving? Like, for example, there's so many subscriptions and stuff like that that I don't even use. And it's costing me like literally hundreds of dollars a year. So I feel like the first thing you got to do is switch your mindset from looking at money for as like, a luxury, and more so as a resource to build wealth. One thing I would do right away is cut off liabilities. Like ever since I got a financial advisor, I started paying off my credit cards. You don't realize how much you're paying interest. You're paying hundreds of dollars in interest a month if you're maxing out your cards. So if you could buy cash, why the hell are you doing it on credit? So first thing you gotta do is assess all your liabilities. I started paying off my smaller credit cards, working my way up to my biggest ones. And so why would I have interest and pay to borrow money I already have? Doesn't make sense. And the most important thing is you got to start taking action. Okay, if you're looking to start building assets to real estate, talk to a real estate professional, talk to a real estate agent, talk to a loan officer like myself. You don't think you have what it takes to get into real estate right now? What you could do is just start buying stocks, start investing in your Roth IRA, start buying entry-level assets that don't have a minimum required investment. And that's one of the greatest ways that you can start. So in conclusion, number one mistake is people spend their money to look good instead of be good. You end up not living good because you're trying to look good. And so don't make that mistake, guys. If you found this video entertaining or valuable, feel free to drop a like to boost the YouTube algorithm. I need your guys' help to become the go-to Chicago mortgage lender. I need everyone to drop a comment. Which liability are they getting rid of this year?